Hello and welcome. I'm QX, and I'm going to take you on a brief little tour of options trading on the Ergo blockchain. For those of you who don't know, Ergo is a proof of work blockchain, which means we secure our chain via mining as opposed to staking with chains such as Cardano. So we'll take you right to this site immediately. This is Sigma O. This was built by Haiti PDLL and Ethereum 12 and 12, Ethereum 1212. Their GitHub's right at the bottom of the page right there if you want to take a look. For those of you that are unfamiliar with options, in super simple terms, we're just going to go over a call right here. Puts can be a little bit more complicated and a little bit easier to burn, but since there are two calls available up on here, we're going to just go over calls in this video. So in short, a call is a promise from the person I'm buying from that I will be able to buy that token or coin from them at any time up to a point in the future if the price of the token goes up to what we've agreed upon. Okay, did you get all that? That's an American call. A European call, which you'll also see on the site, means that I can purchase that after the expiry date of the time that's set. So American call, I can buy up until the point as long as it hits that strike. European call is after that time and if it hits the strike price. Okay, so what's a strike price? A strike price is what it means is if I want to sell you a bundle of tokens, let's say I want to sell you 10 tokens, and I need to say, okay, I'm only going to sell these to you, and you're only going to be able to buy them from me if the price gets to 2 times as much. Okay, that means when I buy that, I can't say I'm going to buy it now and sell it when it's 1.5 times as much. The contract won't let you do that. It has to wait till it's 2 times as much. So there's risk involved. What's the benefit to either person? The benefit to the person selling is the price might not go up 2 times. So then you can never execute the purchase back for those tokens. You actually are out the ergs that you spent to buy that contract, which is typically quite a bit lower, but still it's a risk for you to take and buy it. So that's a benefit to the person selling the contract. Now, the benefit to the person buying the contract is that the price may double, okay, and it may triple. So let's imagine we paid 5 ergs for something that could double or triple in price to be 50 ergs, okay? So originally, let's say for 5 ergs, we purchased the right to buy something for 50 ergs, okay? Right now, that thing, let's say, is 20 ergs. Okay, perfect. Follow me. So before this expires, in an amount of time, if the price gets above 50 ergs, we can execute that at any time and take it for ourselves. But if we don't want to execute and purchase that for 50 ergs, we can wait even more before the expiration date. Let's say it goes up to 80 ergs. Now we're like, oh my gosh, we can actually profit off this. So then I execute the contract. I buy that for 50 ergs because that's what the price was that we agreed upon. And I then turn around and swap it and sell it for 80 ergs. So I've made a profit of 30 ergs. Now the person selling the contract, of course, misses out on that, but hey, that's a risk. That's the whole point of this whole process. So let's see what we have here, and let's read how these works so you know how to do it in the future. So it looks like, I'm going to guess this is Kushti doing this twice because he has charged 0 erg per option, essentially. Which means you can buy the options for free, but you still have to pay for the underlying asset when it's time to execute the contract. Okay, so let's go over what each of this means. So we are saying there's an American call. That means we have the right to buy up until the expiration, which is 21 days. This token, which is Rosen token, if it hits a strike price of 0.08 erg. Okay, so right now, if we look down at the Oracle here, we see that the price of Rosen is 0.283 erg. Okay, so that's 2.5 times. So essentially, what this is trying to sell us is it's saying, hey, if you think Rosen in the next 21 days, you know, who knows when it's going to launch? Could launch sooner than that. If you think it's going to spike higher than 2.5 times, then you right now could spend 0 erg because he's not charging for any of the options here. You have essentially this is risk free. So this is silly not to do it. It's funny that we're doing this in the video, but it's very silly not to do this because it's 0 erg and it's risk free. You're paying a transaction fee essentially. So let's start this over. from there. So we are saying there's a strike price of 0.08 ergs. That means if the price gets to 0.08 ergs, I have the right to buy it for 0.08 ergs. Okay. If the price gets to zero point 0.1 before I notice, I can still buy it from this contract for 0.08. That's the beauty of how this works. Okay, so next is there's 1,000 options. So there's 1,000 of these bundled up. And in each option is one Rosen token per option. So essentially there's 1,000 tokens available. And in 21 days is when it's going to expire. So since it's an American contract again, I have to wait 21 days. Sorry, I have to execute it before the 21 days is up if it hits that strike price. Whereas a European, you have to wait until it's 21 days is up. And of course, in everything else you're going to see, there's going to be a price per option. So let's say the price was a tenth of an erg, 0.01 per option. So multiply by 1,000 if you want to buy 1,000, and then you'd spend that much erg to have the possibility that you might be able to buy Rosen at 0.08 at some point in the next 21 days, if you think Rosen is going to go higher than 0.08. It's probably confusing how I'm explaining this, but doing our best here. And then, of course, the Oracle price here, it shows you how many are available, and it shows you the issuer. Same for auction coin right here. We have 0.8 erg per auction coin. We can see that it's 0.7 erg on auction house right now. That's not that big of a spread, okay? So that means that if you think it's going to go up higher than this, and quite higher than this, seeing how the price is 0 right now to buy these contracts, because she's just doing a giveaway here, then it's silly not to do this. I'm going to do this in the video, so sorry, you guys can't do this unless you get to it during this video. There's 50 auction coins per option, so you see there's one option but 50, as opposed to 1,000 options but one. So that means it's bundles of 50 as opposed to bundles of 1 times 1,000. So that means I can purchase 10 of these or 20 of these options. There's only one option available here, but I'll get 50. Once again, very important, the price down here per option is set to 0 just because Cushy's trying to prime the pump here to show you guys that options are really cool. That should have a price at some point when new options are there, and you'll pay a fee to get that contract. So you have to kind of calculate that into what your risk is. So with American Call on auction coin here, if the price was, an erg per option, I'm getting 50 auction coins that I could get for under an erg if I think the price is going to go almost an erg or higher at some point in 21 days. Calculate that cost that it's going to cost you the 1 erg to buy if that was an erg to buy. So you got to make sure to calculate that option cost in. And don't make the mistake of thinking that, hey, I'm getting 50 auction coins for the price per option here. No. Once again, you're only buying the contract that gives you the right. You're buying a promise from Kushti here, or whoever this address is. I'm guessing it's Kushti. You're buying the option to actually buy it for 0.08. So it's essentially a promise, okay? And again, you can only buy it at 0.08 if the price gets to 0.08 or above. Once it drops down, let's say it's a 0.08 and you're like, I'm going to buy this because I know it's going to continue going up, but you're wrong, and you get to the site and it drops down again, you can't execute it because it checks the live Oracle price of Spectrum. All right. And there are other games you could probably play. I probably shouldn't mention this, but Oracle, right? The Oracle pool, the Spectrum pool for auction coin is very volatile right now. So you could really probably do some options and play with the liquidity pool if you wanted to, and change their ability to actually execute at some points. So you have to, that's not very good to do. That's dishonest. But until these pools are deeper for these, kind of things, and it gets more used, then that's totally possible. So as a buyer, beware of that. Look at the liquidity pools, see if they can be manipulated. We're looking at Rosen liquidity pool, $1 million plus. There's no way in hell that's going to be manipulated to where your calls are going to mess up when you're trying to execute, as opposed to auction coin where the liquidity pool is very shallow, so that can be manipulated to mess up if you need to execute or mess up the price there. Okay. So that's how you buy. Essentially, let's do this live. Let's buy this. So I'm gonna hit buy here. I'm gonna buy half of them. So you guys should come here and buy the other half because they're free essentially. prepare the transaction. It's going to do it in Safe Wallet. For those of you who don't know, Safe Wallet's a fantastic wallet. Just restore your wallet to it. It's great. We'll type in a password. You can see it's just charging us a little fee here. And we have it there. And I'm sorry, friends, but I'm going to buy this whole thing right here. You sleep, you lose. Oh, did somebody already buy it? What happened? Let's try again. Max, okay. It must not like that it wasn't refreshed in between that last transaction. Double spending attempt. Perfect. We have to wait for that to clear. So I'm going to buy that once my TX is done for safe. Give it a go. It's a lot of fun. Thanks for watching.